everyone. I can't believe a quarter's gone by already. And for those of you that haven't met Philip Petursson, Philip is our Chief Investment Strategist sitting in Bay Street in Toronto as we're talking. How are you, Philip?
I'm good, Rod. How are you? And yes, we're doing this from our new location at 199 Bay, downtown Toronto.
Yeah, it's glad that they finally gave you an office to work in, I think after all of these years. Hey, listen, before we get it started, Philip, I wanted to pass along some information that a client shared with me yesterday. And you are the portfolio manager for the iProfile accounts that we have, which is really our flagship portfolio. And they passed along to me how incredibly grateful they were for not just the rate of returns, but the stability that these portfolios continue to provide, particularly when we're surrounded by the noise that we always have. And noise doesn't go away, but the noise in Canada is emotional, without question. And so I just wanted to pass that along to you as a thank you from us as an advisor, but also from the clients, because I don't know if you get to hear that enough.
Well, I really appreciate that, Rod. And it's something that we do not take for granted, the trust that our advisors, you, and the others that we work with at IG and the clients put in us. I mean, we take that seriously. And every day, what we're trying to do is just build a portfolio that gets our clients closer to their goal.
Yeah, well, what I wanted to thank you too was the fact that you put on a jacket today because it's obviously cold in Toronto because it's 32 degrees here in Kelowna.
Well, we keep the offices cold to keep everyone awake.
So I always want to dive in quickly and just get your general overview because, the purpose of this is to help our clients sort of, then I can ask questions that I hear from them and to get some of your insights. And again, I appreciate the fact that you take your time because not everybody has access, right? What I'd hate to say the horse's mouth, but direct access to somebody that really does have, right, his fingers on the pulse. But, the obvious question right now is, how in the world can we have, oil prices that are high, but haven't spiked per se as what people would be fearful of, right? Now, all of that can have a massive economic drag. If there's one drag, it's going to be oil. This is through a war in Iran and the Strait of Hormuz being closed. But yet at the same time, markets are rallying, portfolios are up tremendously for the year. And how do you make sense of all of this for our clients?
Well, it's a great question because, Rod, if all we did was focus on the headlines, we'd want to bury our heads in the sand and we'd want to go to cash and hide in under our security blanket. But that's the headlines, and that would be a reaction to the headlines. What we want to do is we want to look below that. Now, obviously, this year has been another very interesting year. I mean, it never stops. Last year was the tariffs and Liberation Day. This year, it was the war in Iran. To where we are today, which seems that there's a ceasefire, but that could change at any given day. We have this memorandum of understanding that if you've read it, it's quite interesting, in terms of what's in there and what side gets what. But all this kind of comes together to square to your question. How are the markets responding like they are, given everything that's gone on? First, let's address the oil question, because this one was top of mind for everyone. From the start of the war at the end of February through March and April, up until just a few weeks ago, when you're looking at $100 oil, doesn't that mean economic strain? And in theory, yes, because oil prices are higher, that means pump prices are higher, and that's money going into our gas tanks or jet fuel or diesel or whatever it is from somewhere else. But $100 a barrel isn't as punitive as we might think, or isn't as much of a headwind as we might think. We think it's expensive because maybe we're anchored to the first time that we saw that in 2008. But when you start to adjust things for inflation, or adjust them for the market appreciation or the appreciation of gold, $100 oil is not nearly as shocking as we might think it is, just because that's a 3-digit number. In fact, $100 oil today, let's back into inflation over the last, say, 20 years, that would be the equivalent of $45 oil in 2008. So very different. While nobody likes to pay more at the pump, it's not, or it wasn't at the level that would impede economic growth. It increased our spending at the pump a little bit, but it didn't really take that much from other areas of the economy. If we got to $200 a barrel oil, then that's the red flag. Okay, now we're at the equivalent of $100 back in 2008. Now we can face some severe economic problems. But guess what? Oil's back down to $70 a barrel today with that memorandum of understanding. And it's not nearly as much of a concern. But to your other point, which is, okay, but through that, the markets kept going up. Now, shouldn't there have been some type of give back given the uncertainty in the Middle East, given this wall of worry that the market had to climb? Well, potentially, yes. But I would say investors, and if we talk about the market as one conscious being, it was more focused on the fundamentals of businesses and economies around the world than the headlines. And what the fundamentals tell us are that companies are doing very well. We're seeing profit growth, whether it's TSX listed companies, whether it's S&P 500 index companies, whether it's international stocks, emerging market stocks. Their profits are growing between, say, 15 and 25% year over year. And so that's what's been driving the market. It's been the fact that we are in an economic upswing, and that is benefiting companies with greater profitability, and that is what's getting priced into stocks.
Yeah. So again, the average person not following markets closely, right, or understanding what's going on, because it's been led so much by the Great Eight, right? You know, the tech stock revolution, and now there's been a change in the marketplace, and this would have a lot to do with what you're talking about, which is a strengthening of economies, not just domestically but internationally, and you know that's more of a timing affair. But I'd love you to sort of run with that ball if you can for a moment.
Certainly. We look at a number of things on a daily basis as information is updated, you know, whether it's weekly or monthly and so on. And a lot of that starts with where are we in the economic cycle? And we focus on that because what we really want to avoid, Rod, are the severe downturns in the market. A correction can happen at any time, and they tend to be unpredictable. But real negative shocks tend to come with recessions. And so we focus a lot of our time on where are we in the economic cycle, because if we started to see signs of recession emerging, we would start to de-risk the portfolio to try and maintain that stability. We're not seeing any of that right now. When we look at manufacturing, which is one of the key inputs that we pay attention to as to the health of the global economy, it's on an upswing in the United States, in Europe, in China, in most areas that we pay attention to. Manufacturing output is increasing year over year. Trade is increasing year over year. Interest rates are still low enough that they're providing stimulus to the global economy, although we are starting to see some central banks raise rates. It's not at a level that would really put the brakes or slam the brakes onto the global economy. So manufacturing up, shipping up, trade up, consumption up, that all leads to profits being up. And so this is an environment where you want to embrace these gains and embrace what's happening in the equity market, which is why, you know, coming back to our management of the portfolios, we are overweight equities in our portfolios, underweight fixed income, because we see very limited downside risk over the next 12 months and upside risk that is far superior to what bonds can pay us. So lean into where the opportunities are.
Yeah, that's really interesting, Philip, because you know consumption is the key, right? I mean, the Western world is a consumptive society, and so you know we buy. People have to manufacture for us to buy, and I mean, it really is the trigger to all economic growth. Now, I'm going to ask you, what is the differentiation where you see consumption around the world? We still have a global trading world, and you know certainly we're seeing consumption increase in the U.S. I mean, again, that's just the economic rise coming out of an economic deceleration because of the rapidly rising interest rates a few years ago, and that's just a natural evolution. But where do you see consumption not picking up?
Oh, it's a good question. It's difficult because we're actually seeing it across the board. I mean, we think that the whole market has been driven by tech and this AI build out and AI boom, but it's across the board. We're seeing it in terms of airlines. We're seeing it in terms of cruise lines. Your retailers are doing well. Not all of them, but the majority of companies are benefiting. It's not just one sector that is driving this market. It's pretty much the whole market is participating in this rally to various degrees. and consumption is healthy. And I think that begs the question, though, well, where is this newfound consumption coming from? Are people just racking up more debt? In the United States, actually, that's not the case. The debt to household income ratio, which is what we follow. So how much debt do you have? How much income comes into the household? It's actually at the lowest level in 30 years in the United States. It's been on a downtrend, a pretty steady downtrend over the past 20 years, from the credit crisis in 2007 through 2009 to where we are today. So the consumption is actually healthy. And part of it too, to answer the question, then where is it coming from? It's what we describe as the wealth effect. And it's one of our four pillars that we came into 2026 with. The wealth effect is this: you're invested in the market, I'm invested in the market. As our portfolio value increases, we tend to feel wealthier, and we'll splurge a little bit. We'll spend on that new car, we'll spend on some redecorating, or that trip, or going out to a restaurant maybe a little bit more often. And this is all coming out of the gains that we've made in our portfolios over the past number of years that have been quite strong.
Yeah, it was a bit of a loaded question, and the reason though is because not that everybody wants to like it, but the reality is the U.S. is still the economic engine of the world. And if their consumption is increasing, it will increase demand around the world. That is just the way it is. What about Canada? Can I ask you more specifically about what you think about the consumption in Canada, and if consumers are active?
Yeah, and this is where things get a little bit more complicated. From the economic perspective, if you look at the data, which you look at, for example, GDP growth, which is how much did your economy grow last quarter, the quarter before, and so on. If you look at that number, you go, there's a lot to be desired, meaning, it doesn't look great. We've had 3 negative quarters of GDP growth on an annualized basis out of the last 4. And so you'll hear the term technical recession. I use the air quotes because, it's a nuanced phrase. Technical recession is 2 consecutive quarters of negative GDP growth. We had that. But last quarter, on an annualized basis, so you take the quarterly growth and you kind of factor it out, say, if this was the whole year, this is what it would be. The Canadian economy contracted by 0.1%. So it's debatable, how much of contraction that was, especially when you consider that immigration being down, our population growth is actually modestly negative. So that's one of the factors of consumption. As a population expands, well, your consumption naturally will increase. If you have 101 consumers instead of 100, you're going to see an increase of 1%. If you have 99 consumers instead of 100, well, you're going to see a decrease. That's what's been going on in Canada. The labor market has been a little bit more lackluster as compared to the United States. Construction, certainly in Toronto, is much lower than what we've seen over the past 20 years. And so all this is weighing on the Canadian economy. So we're not growing at full potential. We're certainly not growing like the US, which for the first quarter expanded at 2.1% on an annualized basis. We're well behind that. There's things that we need to see improve in our economy. And just our read through of that is that the Bank of Canada is more likely to cut rates one more time before the end of the year, to help support the economy in any way that it can. And we think that that's going to be a good thing. Longer term, look at what this government is doing in terms of all the trade deals that they're signing with countries around the world. I think the runway for Canada is positive, but it's going to take a little bit of time to get that engine going.
Yeah, 100%. That's right. But so, Philip, what was the top performing major stock index in the G7 last year?
You're testing me. I don't know. I would say, we know that the US underperformed Canada, international and emerging markets. I think Canada might have been up 30 some odd percent. I think, Rod, you've looked this up, so you probably know better than I do.
So again, it was a loaded question. And again, this is where I think clients get confused, right? And it's understandable because we hear about the US doing well. We hear about their economy growing. We know that Canada is lagging, and typically you'd see the economies moving in tandem. But right now we're not, and it's not the first time in history, and there is reasons for it, but we do assume that that would catch up. But last year, Canada was in fact one of the very strongest performing indexes, the TSX, in the world, in the G7, in the Western. And so clients would go, why is that happening when we see such a differential between the two economies?
Right. And there you have to understand what makes up our index versus what makes up our economy. And they're two different things. First off, to understand why the Canadian stock market outperformed last year, for a number of reasons, but the biggest one was gold. Gold was up significantly last year. Gold miners were up between 100 and 200% last year. That's about 12% of the TSX. That's going to contribute. That contributed about a third or more of the gains on the TSX last year. And when you look at the rest of our index, and by the way, gold is not a commodity dictated by what happens in Canada. It is a global commodity. Yeah. So it's really a function of what the rest of the world thinks of this beautiful yellow metal. Same thing with oil. Oil, while we mine it here and we pump it here, it is a global commodity. So when oil prices are up, our index does well. When you look across the TSX, more companies are geared or structured to benefit from the global economy than just the Canadian economy. And there's great companies that we can talk about. Saputo, they make cheese. They're one of the largest dairy processors in the world, and yet they're based in Montreal. Gildan Activewear is a t-shirt, socks, and underwear manufacturer, and most of their business is in the United States. CCL is a very exciting company. They make labels that you see on your shampoo bottles and things like that. 90% of their business is outside of Canada. So you look at all of these companies that make up the TSX, many of them, it's not what happens in Canada that dictates their profitability. It's what happens outside. So if the rest of the world is doing well, the TSX will do well regardless of how the Canadian economy is performing.
Yeah, and we as advisors are following, the shifts within the portfolio and the allocations and where they're going, and certainly we saw, an increase. It started probably now. It would have been more than 18 months ago. We saw a dramatic increase in the Canadian content of the portfolios, probably the highest that I remember seeing in about 20 years. To be fair, right? And and definitely it paid off. But I've also known now, I've seen that there's been a shift. Where do you see the great opportunities today?
Well, so we've made a couple of changes in the portfolio over the past or the first half of this year. And a couple of the more meaningful ones, we mentioned gold as one of the drivers of the stock market last year. Well, we've actually exited our gold position. We did that early March. So we didn't quite catch the top of it, but pretty darn close. And the reason why we trimmed our gold or eliminated our gold weight in our portfolio, we still own the gold miners in the Canadian equity portfolio, but the physical metal, we closed out that trade because when we measure gold, it had basically very, very limited upside, but a fair bit of downside risk because on the valuation metric that we use, it was stretched. It was beyond what was reasonable. And so we felt it was a good opportunity to trim it. And then we shifted that position into emerging markets. Now, since we've done that, the drop in gold and the gains in the emerging markets is about 30 some odd percent. Now, we're not talking the whole portfolio. We're doing incremental moves here and there. But one of the brighter spots around the world have been the emerging market equities. China, Korea, Hong Kong, Taiwan, a little bit of Brazil in there as well. These areas have done very, very well this year. They were cheaper than the broad market coming into 2026. This has actually been a position that we've held since Liberation Day last year. I think we've been overweight emerging markets since then, or perhaps even before. And it continues to deliver value for our clients. We think of things in terms of margin of safety in the price. And it might seem odd because people think, well, emerging markets, isn't that risky? Well, not when the valuation is so much lower than what we see in the United States. So you're not paying an exorbitant amount to own emerging market stocks. You're actually getting paid to own them because they are so cheap right now. And I think that's one of the reasons, the recognition of that relative to what US equities are priced at today, that is why we've seen this catch up or acceleration or outperformance of emerging market stocks versus the US and the rest of the world for that matter.
Yeah, and what a statement about the value of international investing, right? And having globally diversified portfolios, but more so having the wonderful access that you have to these, 20 plus companies that are the major players around the world, right? And that you get to work with them to help decide the portfolio allocations. And again, I know our clients are very happy. I mean, everybody loves gains, but it's not about gains. I'm going to say what it is. It's the stability and the unexpected surprises of consistency. And if I could say if there's one thing that our clients want, it's consistency, right? And you're delivering. So thank
Well,
you.
exactly. And I'll just if I can just explain how we think about things
Yeah.
very quickly is Rod, you've probably heard, look, the markets go up 70% of the time. If you looked at any given year over the last 100 years, 70% of the time, you'll see the markets up versus down. Well, that's true over a long period of time. But there are periods like this when you have strong economic fundamentals. The world is growing. You see, manufacturing is positive. Interest rates are favorable. Fiscal spending is positive. In those environments, stocks tend to be up about 90% of the time. And so those are the environments that you say, well, if I walked into an opportunity that I have a 90% probability of seeing a positive gain, I'm going to lean into that. And then in entering into a recession, well, here's where you have a 60% probability of seeing a downturn. Okay, well, I want to shift away from that. So it's all about recognizing the probability at the moment and leaning into it. And that's part of the work that we do in terms of our asset allocation.
Yeah, wonderful. So yeah, so you're looking a year out, of course, right? And so
Exactly.
yeah, so you're very positive. Well, I don't want to take too much more of your time, but I do have one other question. And one of the differentiators that you and your team provide is access to private equity and private debt. And if you want to, could you maybe just talk a little bit about, I mean, it's been around forever, of course, right? But the access for retail investors, right, has been very, very limited. Yet people like Canada Pension Plan, approximately 50% of their portfolios are sitting in this
Exactly.
private equity, private debt. And so do you want to maybe elaborate on how much that is contributing to the stability and also the returns that you're receiving?
Right. And I think that's the most important part is the stability, right? Because so first, private equity and private debt. What are these? Well, these are loans on the private debt side, loans made to companies that the loan itself isn't publicly traded. For example, I could go out and buy Rogers debt, BCE debt. I can buy debt from other companies, the banks. I can buy their debt, but this is debt that doesn't trade publicly. And so what tends to happen is these private companies are looking to borrow, and for the lender, we get very favorable terms, whether it's a higher interest rate, whether it's a tighter covenants, whatever it might be, we can benefit through that. So that we take advantage of that because this debt isn't publicly traded. The price doesn't change day to day. It's a fairly stable price. And so that adds to the stability of the portfolios by reducing that day-to-day volatility because you don't have that mark to market being struck every single day. Same thing on the private equity side. This is ownership of private companies that isn't publicly traded. So it's not like a Microsoft that will be up or down by a couple dollars every single day. There's more stability in the valuation of private equity. And over the long term, because these companies are in their growth stage, that's why they're seeking investors. The returns historically have been higher than what you see in the public markets and the volatility lower. So it might beg the question saying, well, why aren't we all private equity or all private credit? Well, because there still is a risk here. These are smaller businesses, these that are subject to credit, where we are in the economic cycle, where we are in the credit cycle. And so you run large portfolios of hundreds of companies because some won't make it. Some of these small businesses won't make it, but that's, our partners tend to have very, very strong track records of performance. But because the other thing is there tends to be less liquidity. For example, if we wanted to pull our money out tomorrow, well, because there's not a market for these equities or fixed income products, you tend to lock in over a 10-year period. As an institutional investor, and because we're pooling all of our client money together, we can make those commitments with a target weighting of around 7% of our portfolios. So it's not overly exposed to illiquid securities. We have enough that can help reduce the volatility while enhancing the gains, and we can manage the liquidity along the way. And again, historically, as you mentioned, CPP, we are investing right along CPP with some of these deals. We see a lot of endowments and pension plans come with longer term time horizons. Like CPP has an infinite time horizon, so they can invest in private equity and private credit and benefit as a result of it.
Yeah, it's a huge value add for our clients, I can tell you. I'm not even sure they all are aware, but I always constantly want to remind them naturally, because it's, again, when markets are going up and portfolios are going up, everybody's happy. But that 30% of the time when the markets fall, that's when it matters. Right.
Exactly.
It's the defense you require. So I was going to let you go, but now I can't because I got one more question. So we may have fielded a few questions about, SpaceX, Open AI, and a few other things coming up. Both some from a positive aspect, but most from a fear base that this is going to lead to massive overvaluations, fear that a tech bubble's emerging. I'm not even going to give you a direct question on that, but what is your opinion on that? All of that.
Well, coming into the SpaceX IPO, there was a lot of chatter that what is this going to do for the markets? Oh my God, this is a $1 trillion company. Where's that money going to come from? But when you actually break it down, SpaceX raised $75 billion. In the grand scheme of the global equity markets, that's a drop in the bucket. The U.S. equity market, the S&P 500, has a market cap of 60 trillion, right? So, and daily volume on the NYSE is something like 750 billion. So, yes, this was potentially 10% of the daily volume, but it's not such that, Rod, if you had an allocation to SpaceX, and you're like, oh, well, I got to come up with $10 million today. That's not it. You tend to build into a cash position in anticipation of that allocation. So it's not going to rock the market. And as we saw, it was a non-event. It didn't impact any other area of the market. Is there some sense of euphoria out there given how strongly this IPO was received? Potentially. How much should a portfolio own? We leave that to the expertise of our bottom-up managers. And so it could be in the portfolios. We don't know at this point. We have to wait to the next quarterly review to see that. But I think it's all done on a measured basis. And the question of, are we in a bubble? That's always the question. And I think the stock market could be in various stages of a bubble. But is the bubble this big or is the bubble this big? And that's really it. Are we at risk of a major downturn now? Probably not, because the economic fundamentals are pretty solid. And when you compare where we are today to where we were in 2000, far cheaper. That was real bubble mania. Not saying that down the road we can't get there, but I think we can recognize some of the risks and we could mitigate some of those in the marketplace. But do I fear the next big IPO, which could be OpenAI? Could be Anthropic? The answer is no, because we've seen SpaceX come to market. That money gets placed fairly easily. And by the way, there's still $7 trillion sitting in money market in the United States too, that can be placed very, very quickly. So
interesting.
I think it makes for a good story, like a scary story around the campfire. But beyond that, it's somewhat of a non-event.
Love it. Philip, thank you again so much for your time. I appreciate it. And thank you for the commitment to this every quarter. I know I was the first to beg you to do this, and you've been living up to your promise every time. I appreciate it. Our clients appreciate it. We track how many people watch this interview, and it's very highly watched. So you're well loved and respected, also with our clients.
Well, thank you, Rod, and it's my pleasure to do these, and I enjoy them. So let's keep it going.
You betcha. Thank you.